Good morning, everybody. It is Monday, August 25th, 2025. This is Herb Morgan, Senior Managing Director and Chief Investment Officer here at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly macroeconomic and market commentary. As a reminder, you can follow me intra-week. If I've got anything to say, we'll put it on LinkedIn, Herb Morgan, or on X at Herb W. Morgan. Everything you're seeing or hearing today is prepared by me. It's designed for use with you, whether you are a financial advisor or an investor. Doesn't matter, but you're also both expected to make your own investment decisions. Nothing contained in this presentation should be treated as or thought of as investment advice, tax advice, the recommendation for the purchase or sale of a security. Everything's informational, and its accuracy cannot be guaranteed. The views expressed herein are mine and mine alone. They may differ from the views of CFIA's parents, affiliates, or other portfolio managers here at the firm. Well, it was looking to be a pretty rocky week. All week ended up being a big positive up week because Fed Chairman Jerome Powell gave a slightly more dovish speech at the Jackson Hole Central Bankers Symposium event, sent markets up higher. The S&P was only up 1/3%, but look at mid and small cap stocks really rallying on those rate cut expectations. Emerging markets were down a little bit, and the Wilshire Liquid Alts Index down about 10 basis points. So all in all, another really good week as we move into the end of August, and we're having a really good year in financial markets. In terms of economic data, last week we got a fair amount of data on the housing market, which has really been a drag on this economic growth spurt that we're in. The National Association of Home Builders Housing Sentiment Index fell to 32 from 34. Present sales 35, future sales unchanged at 43. Traffic is essentially non-existent at 22. You can see over here on the right, can't tell if that's the lowest. No, it's not. During the COVID shutdown for 1 month, things were worse. And then we head back here again as well. But things just aren't going good in residential real estate. If you already own your home, then of course everything's just fine. Get a great place to live. Housing starts and permits for July. Starts gained 5.2%. The estimate was for a drop. That was a positive, I guess. Single family up 2. Building permits fell 2.8%. In terms of existing homes for sale that sold, that was up 2% annualized and up just basically flat on a year-over-year basis, 0.8%. This is just this long wait for interest rates to come down and to get some sort of indication on inflation, building costs, costs of move, costs, all of that stuff that's just happening. That's just holding, high rates holding the residential real estate market back. Of course, that's sort of equalizing out this long period we had of artificially low interest rates that caused this big run up in real estate prices and big volume and people becoming realtors on the side and making millions of dollars a year, all of that kind of thing. Moving into the labor market, this is where the Fed is, right? The Fed is, well, if the labor market is softening, then we probably would want to cut rates to stimulate the growth. However, if inflation is not softening and inflation is remaining high, we need to keep rates up a little bit to restrict that aggregate demand that would be potentially inflation inducing. I think the Fed's in a harder place than anybody knows. Number one, I don't think the labor market's weakening at all. Number two, I don't think demand is slowing down at all. And number three, I don't think sovereign debt issuance is slowing down at all. We're not stopping to borrow money. We're not suddenly balancing the budget. And so all of this is quite inflationary. And the Fed at some point is going to have to make a decision. I know it came out of this Powell speech this week is that he's open to a rate cut, and I'm sure that's accurate. I just don't see why he would be at this point, given the inflationary pressures in the economy. He should be using the bully pulpit of his position to advocate for more fiscal restraint at the U.S. Treasury level, at the Congress and Treasury level. But weekly claims for unemployment, nonetheless, rose from 224,000 to 235,000. That's still a very, very low number. Continuing claims remain very low as well at 1.972. And if you remember last week, we got a New York Empire State Manufacturing Index reading that shocked us and was up strong, suggesting that manufacturing could be coming back. Well, we got the Philly Fed survey, which is very close to New York this week, and it was down zero point 0.3. So you had it's sort of conflicting. One, you had, Empire State run up, which Philly did last month, by the way, and then Philly Fed kind of flat to a little bit down, no big deal. But then we followed that up with the flash national PMI reading from S&P Global, which was a big surprise to the upside, more in line with what the Empire State or New York State had. Came in at 53.3. The estimate was 49.7. That was the highest reading in about 3 years. Interestingly, the manufacturing businesses that responded to the survey said we're kind of struggling to meet demand. Demand is so good. And they said, and we have all this angst and uncertainty over pricing because of the tariffs. It's causing price increases. So that sort of argues that inflation is not going away anytime soon, and the Fed needs to be very, very careful about cutting rates and sort of stimulating further in here. Now, manufacturing is only about 15% of the U.S. economy, but it has been the piece that has been lagging for quite some time. The services sector has been strong. It remains strong. 55.4. It was above expectations, a little bit below the prior month. Employment strong, expansion, sixth consecutive month reading above 50. And unfortunately, there we saw some pricing pressure as well. But really, all of last week, more than anything else, was about the Federal Reserve, the global central banker meeting, which happens every year in August in Jackson Hole, Wyoming, one of the most beautiful places on earth. The theme this year was labor markets in transition. That didn't really get much press or much care. What everybody wanted to know was what would U.S. central banker, Federal Reserve Chairman Jerome Powell have to say about his openness for a September interest rate cut. And he did signal that he was, in fact, open to that as data comes in, data dependent, said all the right things, but it would be the first cut since December. He pivoted towards more flexible inflation targeting, as he called it. But he stressed, as we always do, we are dependent on the incoming data and what's happening in the labor market. If the labor market were to deteriorate, you could bet there would be more cuts. Of course, the Treasury wants lower rates because that would mean lower borrowing costs. The administration, the president wants lower rates because it would mean lower borrowing costs. But the Fed's statutory objectives are not borrowing costs of the U.S. Treasury. Their objective is price stability. And to do that, they don't have a lot of tools when you have massive deficits at the federal level. In response, the market just shot up, just rallied like crazy. Everybody seemed to be very happy that rates could potentially be coming down. That would help the aforementioned real estate market, by the way, quite a bit. Yields came down a little bit, dollar came down a little bit, and we went back to about an 85% chance of a rate cut at the September 17th, which is coming up soon now, Fed meeting. Powell did, in the speech, sort of reiterate his independence, and he's right to do that. In fact, the president can't fire except in the case of for cause. So anyway, markets took it as a little bit more dovish, and markets rallied, stocks and bonds rallied, sending rates down a little bit. Let's just wrap up here. I think this will be the last earnings season slide until we get into the next one, which would be mid-October. 474 companies have reported. Almost 400, 384 have beat the estimate. The average surprise above the estimate was about 8%. Only 70 companies failed to meet expectation, and as you can see, across the board, pretty good solid earnings surprises. There's a fair amount of data this week. No major political events expected this week, like a Fed meeting kind of thing, but we've got new home sales, durable goods, house prices from FHA and Case-Shiller, both on Tuesday, nothing Wednesday, Thursday, jobless claims, second quarter GDP. Originally came out at 3%, expected at 3.1. Okay, we'll see. Pending home sales, income and spending. Probably the most important is Friday PC price index. Remember, that's not there's CPI, there's PPI, there's import prices. There's so many different ways of looking at prices. But the Fed set their own objective as 2% core PCE annually. They define that as price stability. And if that comes in at 0.2%, which is the expectations, I think the market will feel pretty good. If it were somehow get a little better than that, 0.1, the market would feel really good. And if it was worse, remember that PPI number last week, which was horrific, week before last. If we got something like that, I think you could see the market take a little hit. Although, remember, um, it's just part of the game. 1 month comes on, 1 month falls off. We got Chicago PMI and consumer sentiment as well. Thanks everybody for tuning in. We'll be back again in 1 week. This is Herb Morgan. The name of this is Slaying Bulls and Bears. We look to make the complex and complicated simple and sensical. Thank you and goodbye.